Have you been thinking about purchasing a home in today's real estate market? Are you riding around and seeing all of this new construction and being mesmerized, wondering how could that happen for you? Would lower payments help you reach your homeownership goals today? Well, let's talk.
One, two, three, and
So, some of the things to consider when applying for a mortgage in today's market is what type of mortgage rate are you comfortable with? Are you looking to be in your home for a short time? Are you looking to get in for the lowest mortgage possible? Are you planning to refinance after a short time of being in your home? If so, you may have options that are now being more prevalent in today's market than they were a few years ago. They've always been around, but now there are options as to what type of mortgage rate you are comfortable with than they were a couple of years ago. So those two mortgage options are fixed rate mortgage or an ARM, an adjustable rate mortgage. Let's talk about the differences in the two. A fixed rate mortgage, of course, is a rate that stays the same. It does not change. It's usually for the 30-year life of the loan. It can be for a shorter term, but a fixed rate is just that. It's fixed. It does not change. An adjustable rate mortgage is the opposite. It is not fixed. It does change. However, it can have benefits for someone looking to get into a home with a lower payment or lower rate than the fixed mortgage. So you want to make sure you know the difference between a fixed rate mortgage and an ARM or an adjustable rate mortgage. So if you are a buyer and you're thinking about a fixed rate mortgage, let's talk about what that looks like. What are the pros? What are the cons? And what does it actually mean for you? A fixed rate mortgage gives you peace of mind because it does offer consistency and stability. For example, a 30-year mortgage with a fixed rate would be a mortgage that is at 6.5% for 30 years and it does not fluctuate. It's the same mortgage payment each month. It does not change the mortgage payment. Pros of it, it can give you it can help you with easier budgeting, stable payments, long term planning. You know what the numbers are, and there are no surprises if rates start to climb. Who should consider a fixed rate mortgage? Anyone that is really wanting stability for the family long term. What is long term? Probably 10 years or more. You probably want to consider a fixed rate mortgage if you're planning for stability for 10 years or more. A fixed rate is for those who have fixed income. You know, your your income, your salary does not change. It's the same. And so that would be good for someone to utilize a fixed rate mortgage. Also, first time buyers who are really, really nervous about the market shifting, you probably want to consider a fixed rate mortgage. And again, if you want lower risk with your mortgage, you're not planning to refinance or anything like that, then you probably want to consider a fixed rate mortgage. So let's talk about the ARM or adjustable rate mortgage. What does that look like for a buyer? So, an adjustable rate or an ARM mortgage could help buyers get into more house at the initial time of purchasing a home. So, with an adjustable rate mortgage, you could get in at a lower interest rate, which could help you afford more home that you would if you had a higher fixed rate. It can also start low, so the adjustable rate can start low, and over time, it will increase or decrease. So, an adjustable rate mortgage moves. Usually, the most common time frame is 5, 7, or 10 years. Within that time frame is going to adjust. and it's going to adjust depending on the current market at that time. So again, it can adjust higher or it could possibly adjust lower. An adjustable rate with an adjustable rate mortgage, your monthly payments can increase or because of that, they can decrease. An adjustable rate mortgage can help buyers qualify again for more home upfront because of the lower rate initially. It is best for short term ownership or someone who knows they're going to plan to refinance or again sell in a shorter period of time. An example of an ARM or an adjustable rate is a 5-1. What does that look like? A 5-1 is an ARM or an adjustable rate mortgage at 5.5%. It is at 5.5% for a 5-year term. And then after that, each year it adjusts. So that's a 5-1 ARM at 5.5%. And after 5 years, it's going to adjust. What are the pros of that? Again, you're getting in at a lower interest rate, a lower mortgage payment, and it could be good for a first time home buyer with challenges around affordability. What are the risks? The risks are after that 5 years or after that term, whatever the term is for the loan, the payments can increase or decrease. Your budget is going to need to be flexible at that time frame. It's going to be based on the market rate. It could become unaffordable or it could become more affordable. Who is an adjustable rate best suited for? It's best suited for someone that is relocating with temporary plans. It's best suited for someone who is buying with the plans again to refinance or sell in a shorter time frame. It's good for investors. And again, it is good for first time homeowners just entering into the real estate market, wanting to get in at a lower mortgage price. So that's how an adjustable rate works. With an adjustable rate, you need to be extremely intentional. You need to be able to plan concretely and understand that the rate will adjust. All right, I hope that helps you when making decisions regarding a fixed rate or an adjustable rate. So the best rate is the one that fits your goals, whether it's a fixed rate or whether it's an ARM or adjustable rate mortgage. The best one is the one that fits your goals. So don't chase the rate. Understand what the long term impact is. Everyone's situation is different. Everyone has a different need, different wants, different goals, and different desires. So let's get together. Let's create a strategy that meets your needs and your goals.